The stock market just keeps hitting fresh all-time highs. We just hit a new one on the SPY, the S&P 500 ETF, and I want to talk about what we should be doing in a market environment like this. Should we be buying more stocks with anticipation that new all-time highs are coming next, or should we wait for a pullback? And at what point is it a good time to start buying stocks? I'll share my opinion on this in today's video. All I ask is that as we get started, hit the thumbs up button, subscribe, and I'll show you a couple of my favorite stocks in this market right now. So there's no question the S&P 500 and the stock market as a whole has been really strong recently. But remember that the SPY has heavy weighting towards some of the mega tech stock companies. Speaking of which, here is the S&P 500 overall heat map with a 1 month relative performance at the time of recording this video. The reason I want to show you this chart, my cat's dispenser's going off. The reason I wanted to show you this chart is because the big tech names have been seriously pulling the line for the overall index. Just take a look at Nvidia. In the last 1 month, the thing's up almost 20%. Microsoft up almost 7%. Apple almost 6%. Broadcom, AMD, Texas Instruments, Intel. Some of these semiconductors are seriously pulling their weight in the S&P 500. Notably, we also have some big winners in the industrial sector. I think part of this is because of Trump's big, beautiful bill, which seems to have a ton of potential spending for infrastructure build out, and companies in that world love that. But the reason I wanted to show you this chart is because there's pockets of this market that have not nearly participated as much. For example, software applications have not been particularly attractive. Consumer defensives have been lackluster. Healthcare plans have been getting hit hard. We'll talk about UNH later in this video and whether I think that's a buy or not. And healthcare as a whole has been a lagging sector. We'll talk about that as well. Credit services have also been lagging behind. MasterCard, Visa, and insurance companies have actually been taking a little bit of a hit. So we've got a little bit of mixed performance. So let's take a look at the RSP. What is the RSP, you might ask? Well, I would encourage you to add it to your watch list because the S&P 500 equal weight ETF shows a little bit of a different story than the SPY. Remember that the SPY heavily weights towards those big stocks that we just talked about. Your Metas, your Nvidias, your Amazons. But the RSP takes a look at the S&P 500 and it equal weights everything in it. Think if you had $500, you'd put $1 into every company rather than $5, $6, $7, $8 into each one of the mega cap stocks, right? So what happens with the S&P 500 is it heavily loads into the biggest and best companies. Here's a little trick for your TradingView. You can actually do SPY/RSP, and this is the SPY versus the RSP, or the market cap weighted S&P 500 versus the equal weighted. And what you can see here is that the market cap weighted has dramatically outperformed due to the winners that are just knocking it out of the park. Of course, I'm referencing the one and only, the big, the beautiful Nvidia. Nvidia just hit $173 per share. And as a shareholder of Nvidia, I'm definitely not complaining. I've got 500 shares of Nvidia with an average share price of $111.31. And this thing just keeps going. But I had somebody ask me on my video the other day, they said, Nick, should I be buying Nvidia at these levels? And in my opinion, when it comes to the overall market, I do think things are a little bit stretched. If we apply a Bollinger Band and the RSI to our charts, some simple indicators suggest that the upper limits of the Bollinger Bands here for Nvidia are coming into play. In the last few years, typically when you've topped out in the topper end of this Bollinger Band, it has been generally a decent time to take some money off the table. That is except for right here and right here, which have continued to push higher. But this is, in my view, looking a little bit stretched. However, am I going to sell my shares of Nvidia? Well, Nvidia is in my portfolio for the long term. It's a stock that I really like and I think has plenty of upside in years to come. The closest thing I would consider doing is that if Nvidia continues to march towards 200, I'd probably look to sell something like the 220 calls. But right now, if I was to sell the 220 calls on Nvidia with 1 month out an expiration date, I would only collect $100 on my 500 shares tied up in this position. So it's definitely not interesting to me at this time. But if the stock were to continue to melt higher, I may look to sell some calls if the premium starts to get attractive. I mentioned healthcare, which has been a pretty unattractive area in the markets here recently, but there are several names in the healthcare space that are highly profitable businesses that I would be interested in if we continue to see this thing start to get a little bit more oversold. Specifically, the highly profitable and highly controversial stock United Health Group. With all the drama here recently between the CEO situation, the questions of or allegations of malpractice and things like that with United Health Group, this thing has been an absolute disaster stock in 2025. Take a look at the weekly chart. Look at this. This is a nasty, nasty chart. However, prior to this, if we could look past what's been going on recently, this has been a massive winning stock over the years. And in my opinion, the underlying business model is still intact and highly profitable. So in my view, this big drop-off in the stock price presents what I believe to be a long-term possibility of a nice entry on the stock if you like it for the long term like I do. The Bollinger Band's lower limit is getting tested, as well as the RSI flashing an oversold status. And if we look at UNH in terms of their financials report, you can see things have remained relatively steady in terms of their overall income statement, revenue and net income still looking solid for this company, with pretty consistent profit margins as well at 5.74%. And of course, the PE ratio has fallen off a cliff here recently with the stock price in the dump. Trading stock was a $570 plus stock, now trading below $300. Here's a look at their earnings per share actual versus the earnings per share estimate, essentially what was delivered in their earnings calls. And you can see that 3 out of the last 4 quarters have been beats in terms of their overall earnings per share, with the latest quarter showing a miss. By the way, the tool that I'm using here is called the A1 Stock Box. If you want to track financials report data, looking at income statements, PE ratios, and more, the link can be found to try it out in the description down below. You can also track crowd sentiment through the Investor Sentiment Survey and track stocks hitting their 52 weeks high and low points. For example, Microsoft, Taiwan Semi, Palantir, Nvidia. These stocks are flagged as stocks hitting fresh highs. Then you have GIS and IT, things hitting 52-week lows. You can also check out our market breadth charts, and one of my personal favorites, the pullback setups chart. For example, check out Meta, getting a reading that it is currently pulling back. Here's a look at the chart, pulling back in a nice overall upward trend. And we also have bullish and bearish pullback setups scanning at all times. So if you want to check out the stock box, make sure to use the link in the description down below. Now back to the video. And with earnings coming up at the end of July, I do wonder if the stock continues to get hit hard, if this could produce a oversold reading where I may actually start to get interested in the stock by selling a cash secured put. My only hesitation with selling cash secured puts is that the S&P 500 is near all-time highs and does look a little overbought in my view. Additionally, if we take a look at the volatility index or the VIX, this thing is also back to multi-month lows. And so I would much rather sell a put on UNH or other stocks that I like if volatility was higher, giving me a more expensive premium to collect in the instance that I were to sell a cash secured put. And for those of you guys who have been following along with my struggles with Robinhood stock, yeah, the struggles are continuing. We are still dealing with a situation in which the stock just keeps grinding and melting higher, and I am stuck behind the wheel with calls that I've sold out till August 15th. So I've still got a month left on these $95 calls. But the issue here, if you don't understand calls and puts or options in general, I'll explain this as simple as I can. Essentially, I own 600 shares of Robinhood at a initial average entry of $40 per share. So I've done phenomenal with this stock. The challenge, however, is that I've been selling calls against my position. Now, when you buy calls, obviously you want the stock to go up. When you sell calls, you benefit from the stock going sideways or down. But what happens if you own the stock and you sold a call? Well, in that situation, you really are betting that the stock has limited upside. And if it continues to go too much to the upside, what happens is you lose money on the calls and you make money on the shares, essentially capping your wins above a certain strike price. In this case, I have no additional gains to make on this stock. Even if it went to 120 right now, I wouldn't make anything further on my current situation. However, if we were to get a little bit of a pullback in the stock between now and the X date of August 15th, what would happen would be I would make profits on the $95 calls that I shorted, but would also be sitting on a very nice gain in the stocks, in the shares that I own, the 600 shares. And I can't remember if I mentioned this in my previous video, but I did end up pulling the trigger on these $370 calls on Tesla. So I own 400 total shares of Tesla and have also sold calls at the $370 strike price. What this means is that if the shares go sideways, I just pocket the premium on these calls if it by expiration date has not gone at or above $370 per share. If the stock goes down, I also hedge my bets slightly by collecting $6.10 per contract that I sold. Remember, a contract represents 100 shares of stock. Pulling up the handy dandy calculator, if we do $6.10 per contract times 100 shares times the 2 contracts that I did, I collected approximately $1,220 for selling these calls. One of my favorite things about trading Tesla is the volatility. Because this stock is so volatile and can move in both directions very aggressively, selling options on it can be highly profitable or highly disastrous if you don't know what you're doing. But these calls that I've sold are covered calls. As I just got done explaining, I own 400 shares of stock, so I benefit from this thing going up. But by selling this call, I'm capping my upside at 370 in exchange for collecting income no matter what the stock does. Remember, I'm pocketing $1,220 on this sold call. So sometimes people ask me, then what's the downside to writing a covered call or selling a covered call? If you know you're going to make $1,220, why wouldn't you just be doing this all day long? Well, I do it often because I like covered calls and I like selling options. But the downside would be if Tesla were to skyrocket to $450 per share, I capped my upside at 370, no matter how high it goes. So the market is essentially paying you to cap your upside because somebody else wants to buy that call and believes that Tesla's going to rip that high. I like the shares, but I don't know that the Tesla shares are going to go up that much in that short of a time. So I've decided to sell the calls and pocket the premium in the meantime. In fact, I'm actually doing covered calls on several stocks right now. I've got calls sold on Robinhood, Lulu, Airbnb, and Delta, American Express. I have a cash secured put, which is not a covered call. It's when you're selling a put on ET, which is a energy stock, and Energy Transfer is the company. Exxon Mobil, and of course the Tesla position I just discussed. And today I actually took a position on oil through the ETF USO. Unlike my standard stock trading strategy where I'm looking to sell options, collect income, and buy stocks and companies that I like for the longer term and trade around them, this is a little different. If you're familiar with my other channel, just my Trader Nick channel where I talk about commodities, indices, and Forex, then you may have already seen this trade. But I went long oil with 1,500 shares of USO with a stop loss below structure here. I do think oil prices have more upside. To address why, I figured it would be good to take just a quick look at our macro screener within the stock box. On July 17th, we got better than expected retail sales, showing the consumer is looking relatively strong. Inflation continues to cool. We got good PPI numbers and on-target CPI numbers this week. And unemployment rate went from 4.2%. It was expected to rise to 4.3. It actually went down, which is strong for the jobs market, showing a nice decline in unemployment rate. We also had better than expected jobless claims here this week, and the previous NFP report came in much better than expectations. So all of this to say, we have jobs market data that looks pretty strong and inflation that seems to be cooling. That's an environment in which I think the demand for oil can remain strong. Remember that when it comes to oil prices, it's all about supply and demand. And if you're going to be trading or investing in energy companies or oil futures or whatever you trade, you want to consider both of these things. The supply side of oil prices and of course the demand side for oil prices. What I just got done discussing with strong retail sales, good jobs data, and cooling inflation suggesting rate cuts are coming in the US, I think there will be strong demand for oil prices as economies grow. On the supply side, I don't see any giant impending disasters in terms of the supply chain or global geopolitical tensions in the Middle East and in the Ukraine. These things seem to have calmed calm down. So I wouldn't necessarily call those bullish catalysts. Remember that threats to supply of oil can actually cause the price to go up, and more supply flooding the market can cause oil prices to go down. So I don't really see this as a huge risk or tailwind to my idea. I really just see strong demand with some good economic data that we've had out of multiple countries here recently. So I do think personally that the risk to reward to oil and energy stocks is more attractive to be long than short. Another stock that I like is Exxon Mobil. This company produces consistent revenues, and while revenues have topped back from 2022 with, of course, Ukraine and Russia going at it really caused oil prices to spike, we still have a situation in which they produce very consistent returns, and this company pays a nice dividend. If you're newer to trading or investing in stocks, dividends are payments that get paid to stock investors that hold the stock through the ex-dividend date. So when it comes to Exxon Mobil, the reason I like having stocks like this in my portfolio is they pay me to wait on the stock and simply to hold it through the ups and the downs. And while the stock has mostly traded sideways in recent years, I think that if we get economic expansion in the US and other places, the demand for oil will remain strong, which could bolster the stock performance of Exxon Mobil as well. So Exxon is a position that I have traded in and out of many different times over my stock trading career. So let me show you what I currently have in terms of a position on Exxon Mobil. This is one of my favorite stocks to trade options on, mostly because it's a company I'm kind of always happy to build a position in, but also can collect premium while I wait for the stock to go back and forth. As you can see here, I own 200 shares of Exxon Mobil with an average share price of $107.08. The stock has mostly traded sideways since I bought into the position, but I've been able to sell some calls, and specifically right now, I'm selling the 110 call out until August 8th. Back to our handy dandy calculator. Remember that in this circumstance, I sold 2 contracts against my 200 shares of Exxon Mobil, making this a covered call position. So if I do 2 times 3.76, which is how much I collected for selling this call, you can see I collected a total of $7.52 in premium. We multiply that by 100 since each contract represents 100 shares. So in this situation, I collected $750 for selling the 110 strike price calls. Because my overall exposure to the stock, the average price is $107, I can also make approximately $3 per share. And because I have 200 shares, I can also make about $600 in share price appreciation. So my max possible win on the Exxon Mobil trade, if the stock were to be above 110 by August 8th, would be $752 plus $600, approximately giving me a upside potential of $1,352 on my Exxon Mobil trade. If you're interested in learning more about options, we do have a free options course available. I'll leave the link to the options course down below in the description of this video. I hope this video was helpful to you, and have a great weekend.